We're talking with David Resler, chief economist of Nomura Securities International, and also someone who worked at the St. Louis Fed. He rejoins us from his offices in downtown Manhattan. Hey, David, during the break, Eric and I gave you those numbers, the breakdown in terms of that ADP report. Any more thoughts as you kind of got more specifics on the results?
No, I think that this ADP report overall is pretty consistent with consensus forecasts for non-farm payrolls. Looking at the details, I think showed a 65,000 drop in manufacturing employment. That was a little larger than we might have expected after seeing the ISM number the other day. And the manufacturing part of this survey has been most closely correlated with the with the non-farm payroll report. So that suggests we're going to have a little bit larger job loss in manufacturing than we expected. But otherwise, it looks pretty consistent.
David, for the second month in a row, there were fewer losses in the services sector than there were in the goods-producing sector, and that breaks a trend that we had seen take place over the several previous months before that. What does that tell us about the economy and the services industry?
Well, I think the services industry is where we're waiting for the turn to begin. Manufacturing has improved generally. The trend there has been toward smaller job losses, and generally the news from manufacturing has been more encouraging than that from the services sector. The slower job losses in services tell me that the service sector may be starting to join this recovery.
All right, so let's spin it forward because, David, obviously another focal point today, this week, is what we hear from the Fed here at 2:15 p.m. Eastern. Anything significant that we could get from the Fed that could maybe change the tone that we've been getting from the Fed over the last few weeks, last few months?
Well, I think the Fed is the statement today is likely to acknowledge what we've seen in the GDP report last week and other recent evidence suggesting that the economy's contraction has ended, that we're now in some sort of recovery. I think there'll be some sort of acknowledgement of the improvement in the economy in this statement today. What I don't think they're going to do, though, is change the key language about the extraordinary easy conditions that exist and will exist for some extended period. I think that is on the table for discussion, but we won't learn much about that discussion in all likelihood, for another 3 weeks when we get the minutes of this meeting. And there we'll get more context to this statement that will come out today.
David, do you think we're going to hear anything from the Fed that would reflect what we saw earlier this week in the ISM manufacturing report, prices paid, maybe suggesting that there is a little bit of inflationary pressure building somewhere in the economy?
Oh, I would be hesitant to say that the rise in prices paid index says that there's any kind of inflation pressures developing. Most of the price evidence we see is that prices are still weak or falling. Or certainly weak compared to what the Fed would like. I think it's encouraging news that we're not entering a period of deflation, which was the Fed's major concern at the beginning of the year. So the Fed won't be very concerned about the prices paid index. What they will probably be encouraged by is the third straight month of above 50 reading in the ISM index. And I think that's a precursor of generalized improvement in manufacturing. We've seen some of it in the employment numbers in that sector. We've had extraordinary growth in productivity in the last couple of quarters. We'll probably get something close to 7% in the third quarter. And okay, when we get to now we won't be able to push that productivity envelope. We're going to have to start hiring more workers.
All right, got it. David, thank you so much. David Resler, he's chief economist over at Nomura Securities.